When will the interest rate tightening cycle pause? The Fed reiterated that ongoing, and they did use that word ongoing increases will be appropriate. Ongoing was the word we told you yesterday you needed to listen for. And clearly, we were right because he said it. It's still going. That means they're maybe not ready to pause, but this is almost like a Rorschach test because I heard one thing and one of my guests heard another, and I can't wait to hear what Peter Schiff said. So let's bring him in here to analyze what we've just seen unfold and whether there's a chance this might be the last rate hike. Our NAT Alliance's global fixed income chief, Andy Brenner, and Euro-Pacific's Peter Schiff. Andy, to you first, how much do you think, if you climb inside his head, tell me exactly what he meant when he kept saying the job is not done, but the markets are continuing to move higher?
Liz, everything you just pointed out, and you did a great job of it. The dollar is lower. The equity market's higher. The bond markets are lower in yield, higher in price. Everything points to this is the last Fed tightening.
Well, where did you get that, Andy? I didn't hear that.
Because what he said is, you're right, he did say ongoing increases, but he also said that we need to stay on it. And staying on it is where you are right now. You just raised Fed funds to 4 3/4. All right, you have your PCE deflator at 4.4. This is the first time in years that you've had the Fed funds rate higher than the PCE deflator. That by alone, he doesn't have to raise rates anymore. The markets will do the rest for him, and the markets do not believe he is going to tighten further. This was a more than dovish, not quite in the dovish camp. This is a neutral to dovish speech, and people were looking for a very hawkish speech, and he didn't give it. Having said all that, I always wait 18 hours before I really take the full effect of what the Fed has said.
18, not even 12. Okay, Peter Schiff, what did you hear? I heard an osprey. I heard a hawk saying over and over again, the job is not done. Andy thinks this very well could be the last rate hike. What do you think? What did you hear?
Well, it may be so, but not because inflation is coming down. Inflation is going to get much worse. In fact, what I heard from Fed Chair Powell was a lot of economic ignorance, especially when it comes to inflation. First of all, he said that he welcomes the disinflation. That disinflation is transitory. Maybe he doesn't realize that yet, but it is. But he also claimed that inflation is caused by consumer expectations. He's wrong. Expectations don't cause inflation. Neither do wages and prices. He said he was worried that maybe a wage price spiral could develop, and that's why the Fed wants to make sure it doesn't happen. The wage price spiral was a fiction invented by Keynesians. Inflation is caused by the government. It's caused by the Federal Reserve printing money and then Congress spending money. That's it. And spending is going up. In fact, he encouraged Congress to raise the debt ceiling so Congress can borrow and spend even more money. Ultimately, the Fed is going to monetize that debt. And we've only seen the beginning of inflation. And in fact, Powell said that inflation is creating misery for families. It's the government that's creating that misery and the Fed because they're the ones that are creating the inflation.
Well, you certainly have got, and this was a Paul Volcker, Ronald Reagan thing. Paul Volcker kept rates incredibly high to douse stagflation, but Ronald Reagan worked with him to cut spending. But I'm going to push both of you on this. I didn't hear what you heard. I heard there are more rates to come, and there's a very big danger in stopping short. Let's listen to what he said that jumped out at me.
The risk of doing too little and finding out in 6 or 12 months that we actually were close but didn't get the job done, and inflation springs back and we have to go back in. And now you really do worry about expectations getting unanchored and that kind of thing. This is a very difficult risk to manage. Whereas, of course, we have no incentive and no desire to over-tighten. But if we feel like we've gone too far, we can certainly, and inflation is coming down faster than we expect, then we have tools that would work on that. So I do think that in this situation where we have still the highest inflation in 40 years, the job is not fully done.
Okay, Andy, I'm sorry. I think you're wrong. I think you're wrong. I do not see Powell pulling his foot off the gas yet.
Liz, I stand by my opinion. Look, this is the same Fed that told you 1 year ago that today Fed funds would only be at 1%. They're at 4.75% now. I don't believe the Fed. I don't believe they have good economics. I agree somewhat with what Peter was saying. I think the Fed is wrong in more instances. And if you listen to the very end of what he just said, he said we have the tools that if inflation were to come down faster, we could do things, meaning they can ease. I still stand by the fact that this is the last rate increase, and the Fed eases by the middle or the third quarter of this year.
And Peter, what is the danger of that?
Well, inflation is going to run out of control. But remember, they've already slowed down the pace. They only went 25 basis points. And even if we get a couple of more 25 basis point hikes, it's not nearly enough. And also, you have to look at the effect that higher rates have had on consumer behavior, which is pretty much nothing, because credit card debt is at an all-time high. Savings are at an all-time low. So the higher interest rates have not stopped spending and encouraged savings, which is exactly what has to happen to bring down inflation. Meanwhile, as I said earlier, the government continues to increase spending. And if Powell thinks that a slowdown in the economy is going to reduce inflation, he's wrong again. That's actually going to fuel the inflation fire. So the real risk is that we end up with a financial crisis and a much more severe recession than the Fed recognizes. And then the Fed tries to prop up the economy and try to stimulate or combat the financial crisis by creating even more inflation.
I need to get to the possible investments here. You know, Andy, we actually had Rick Reeder of BlackRock on the show, and he said this is nirvana for the bond market investors right now because yields are so high. As they come down 9 to 11 basis points, depending on which part of the yield curve you're talking about, are they still good investments to park cash?
Liz, the front end of the yield curve is the best place to put money right now. Inside of 3 years, in corporates, you can still get 5%. Mortgages make sense. You know,
3 month. Let's show 3 month. Let's show 2 year if we can.
All right. I mean, the cheapest part of the curve right now, at least it was when I walked in, was a 6-month bill. I bought some yesterday. I mean, I think it's incredibly cheap, 4.80 yields. But you can get 6% in short, high-grade corporates. So, I mean, I think that's the place to go. I would stay away from duration. If Peter's right and the bond market's going to go crazy to the negative, then you certainly don't want to be out in the long end.
Let me give a shout out to you, Peter, because you've got two funds that have just been ranked number 1 and number 3 in the international fund area. And specifically, these are by U.S. News and World Report, foreign large cap value. You're number 1 for your dividend paying fund, and you're number 3 for your foreign large value fund, international. And we can show some of the holdings in here, but you're beating Goldman Sachs is number 2, but you're beating, Vanguard and some of the biggest funds. What is it about foreign large cap value stocks that are good in this atmosphere?
Well, first of all those funds are in foreign large cap value stocks, so we've just got better stock picking and better sector allocations. But first of all, on bonds, I think bonds are a sucker bet. I mean, even if you're talking about 5 or 6% yield, inflation is going to average more than 5% over every one of those years. So you're going to lose money in bonds. If you want to avoid losing to inflation, you've got to get out of dollar-denominated assets. And foreign dividend-paying stocks are a great place to look because you can get dividend yields that are as high or higher than some of these bond yields, but you have real assets that can rise in price as inflation continues to erode away the value of the dollar. And, last year the dollar was up, and that subtracted from the returns on my funds. But so far this year, the dollar is down. In fact, today it just hit a new low for the year as gold hit a new high for the year. And I think this could end up being one of the worst years ever for the U.S. dollar, and therefore one of the best years ever maybe for gold.
Yeah, gold's
and so investors should be looking there. I have a gold fund and also emerging markets, which, lagged last year. They're beating the U.S. market so far this year. And I think a weak dollar is going to be particularly bullish for the emerging markets. So investors should be looking there rather than U.S. stocks or U.S. bonds.